we'll try to take the dogs outside for that.
Hey everybody, welcome to the Metastock webinar room. I hope you're doing well today. I want to say thanks for coming. Today we have a very special guest, and let's go ahead and review the legal disclaimer. So today's demonstration is designed to instruct you on using Metastock and the accompanying add-ons. It's not a recommendation to buy or sell. Oh wow, this is a little bit of a different legal disclaimer than I'm used to. Give me just a second here. All right, so today's demonstration, let me just pull one real quick. I have this memorized usually, but Perry Kaufman's legal ease is a little bit different than mine, so let's go ahead. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So we got through it. Sorry about that. Do want to tell you a little bit about Perry Kaufman. Perry Kaufman is really literally somebody that really doesn't need an introduction, but he has a really interesting story. Like, he started working on space programs. He worked on the Hubble telescope. The reason we started working with Perry Kaufman personally was he was somebody that was recommended or referred to me by a really good friend of mine, Teresa Wong, in Hong Kong. And apparently he's very popular down here. He's written about 13 different books on trading. I'm going to let him tell you a little bit more about what he does and his history, but he's definitely a great trader. I'm looking forward to hearing from him today. So Perry, I can hear you there in the background. How are you doing today?
I'm doing just fine. Thanks everybody for joining.
Welcome.
Well, thank you very much. Just so you know, the disclaimer that I have on this, if I'm in control of this, we'll move forward.
Yeah, you should be in control.
I can't see, whoops, let me see. No, oh, there it is.
There you go.
Let me just summarize this. It says you can't believe anything I say. It's a typical government disclaimer. It says that there are risks, and I'm sure you've seen all this before. If you'd like, you can read it yourself. In any event, I think we'll just move on to the presentation. Now, let me give you a little background. You'll see why I have these little pictures of the Aurora Borealis and some space things, because they started in the space industry, in the aerospace industry. And it wasn't the Hubble Space Telescope I worked on. It was something much earlier than that, because this was in the late 60s. And nobody had even thought about the Hubble Space Telescope at that point. But I worked with a team of people on the navigation for Gemini. And those of you who are a little older will know that Gemini came before Apollo. In order to use the navigation in Apollo to get from the Earth to the Moon, you had to develop it on a previous vehicle. And so we did that on Gemini. It was very exciting. As a young person, I was at launches, and I couldn't possibly imagine doing anything better when you're young. After that, I did satellite reconnaissance. Some of you may be familiar with the term spy in the sky. We would position a satellite, say, over Moscow, and our secret agents would transmit information up to the satellite, and the satellite would transfer it to the Pentagon. So that was all fun for a while. And then the security became a little overwhelming. and my skills got a little better, and I formed my own computer company. So in the early 70s, we started, I won't go through too much stuff, but we started our own company, and a customer came to us who was interested in trading the markets. And so we were mathematicians and thought that was a neat idea. And so we started doing that then, and we've been doing it ever since. I have managed extremely large portfolios for an oil company. I have created my own intraday trading company, which was sold to ED&F Mann in 1998. And as it said, I work with Graham Capital, Mizuho Bank, a central bank, and doing all sorts of strategies, including arbitrage, carry, trends, and the like. When you've done this for a long time, you do a lot of different things. So, and as Jeff said, I've written books. The most popular ones, or the most recent ones, is this Trading Systems and Methods, which many of you may know. And recently, this little guide to creating a successful algorithmic trading strategy, which is really written from the questions asked by attendees at seminars. I found that the questions that they asked were very insightful. And I put them all together, organized them, and decided that a book focused on these questions with a little filler here and there and some background would be very useful for people developing their own trading systems. And that's what it is. So let's now move forward and talk about the systems. There are three systems in this add-in. One is called the short cycle, and it's a pattern system. One is high momentum, which comes out of a concept that was very popular in the late 1990s. And the last one is a mean reversion program that is, as I call it, a little geeky because it's a little technical play that turns out to be very robust and very profitable. And I'll explain each one briefly, but so you understand what they are. First, you should know that these are short term. Most of them trade 1 to 3 days. The mean reversion may trade up to 8 or 9 days. Now, and they're not intraday. They really they calculate using the high, low, and close, but the orders will all be placed on the open, and you can place them in advance. There'll be profit targets, which you can place in advance, and exits and entries. So the nice thing about short term is that you don't have to suffer these really long drawdowns that you get after a trending move in the market. And I like trend following, and I use trend following all the time, but there's a large risk involved in it, and you have to be prepared for that. And personally, I find that these short-term strategies are fun. You get to take profits and put money in your pocket. As I say in the bottom here, that 50 to 80% of the trades will be profitable compared to 30% of the trades for trend following. So I find taking profits a lot more fun than watching the market go against me, even after I've had a good run. So I hope you'll find it interesting. They're not really very time consuming. You'll see that everything is calculated after the close and you place orders for the next day. Pretty straightforward. So let's just discuss a couple of concepts that we'll be using. Mean reversion profits by going the opposite way from the immediate price move. And you know that a lot of successful traders claim that you don't want to go with the crowd. So mean reversion is essentially doing the opposite. Market's going up, we're going to sell. Market's going down, we're going to buy. That also means that we're not going to have any slippage or very little slippage on the trade because we'll be going that direction. And you won't have to stand there while you're trying to get long something that's going up and watch the market move away from you. These systems, because they are short-term and they are basically all buying when price is going down, work best with noisy markets. Noisy markets are markets that go up and down all the time. They don't go the same direction. In fact, the S&P and the index markets are the noisiest markets, mostly because they have very broad participation, including people doing buying and selling for all sorts of reasons, whether it's their own system or they're just liquidating or they're getting in because of some advice from Fidelity. Whatever it is, lots of people participating in a market makes a lot of noise. And we're going to take advantage of that by assuming that the market's not going to continue to go the same direction, but keep changing direction. And the engineers call this white noise because it really has no underlying meaning other than, as I say here, the reaction to random flow of orders. Here's a little chart where I plotted the noise over the past 30 years of various markets. Now, this is really, the noise is measured upside down. The market on the left, which is Eurodollars, has the least noise. So the higher the number, the less noise. Technically, the ones on the left are best for trend following. The ones on the right have the most noise and they're best for mean reverting. So you'll see on the left, you have Eurodollars, short sterling, and the euro. These are very trending markets. Eurodollars, because the price of Eurodollars is held very closely to the Fed interest rate. And on the right, you have these index markets, which I've said tend to be extremely noisy. Euro stocks is by far the noisiest of the European markets. The Russell and the S&P are very noisy markets over here. Now you notice in the middle you have the DAX and you have the NASDAQ way over to the left. These are markets that tend to make bigger, faster moves. You've probably noticed that yourself if you trade them. So they're not great trending markets, but they're not real noisy markets. They're somewhere in between. So I just thought it would be interesting to show you. I measure noise using something called the efficiency ratio, which if you've read any of my stuff and you've looked at my adaptive trend called the KAMA, K-A-M-A, it uses this ratio, which measures the distance that price moves over the path that it goes, kind of like a drunken sailor's walk. So a drunken sailor will, when he's leaving the ship and going to the pub, will go in a straight line from the ship to the pub. On the way back, however, he'll wobble along in different directions, eventually getting to the ship, but taking him much longer, bouncing into walls and going back and forth, ever forward, but surely not in a straight line. So we call his trip from the ship to the pub no noise, and the one going back noisy, and the amount he wanders back and forth is the different levels of noise. So we're looking for markets that wander back and forth, even if they eventually go in one direction. So this is just a summary of what I just said, looking at those charts. Mean reversion, we'll look at equity index markets, and it turns out that we can also look at the long-term bonds. Long-term bonds do not go in a straight line as the short-term interest rates go. So we'll have an opportunity to trade those. And just on an aside, although it has nothing to do with what we're talking about here, if you're trading, if you're a trend follower, you should be looking at the short-term interest rates, the euro and crude oil as the best trending markets. So another concept that we'll need here is that some markets have a strong upwards bias. Now we know that index markets are that way. I've traded them for years. The index markets go up slowly and sometimes erratically. On the other hand, they go down very fast and for a short period of time. As a trend follower, it's very difficult to capture a profit on the short side of the index markets, because by the time you recognize that it's turned down and go short, the move is almost over. And then you have to hang in there while it turns back around and goes up. By then, there's no profit left. Now, on the other hand, VIX is what we call extreme seeking. It likes to go up and up and up to highs and then come down and down and down to lows. It has a little different pattern because it goes up very fast and comes down very slowly. You'll find in the system that trades VIX here that you'll make a lot of short sales, and it will have a very high percentage of profits. It will make some money on the upside. It won't trade it very often. It won't stay in very long. But this last phrase, don't fight the bias. We will be mostly long the index markets and short the VIX. And that's the way to make money in these markets. So here's a little picture. You can see Eurodollar futures on the left from 1981. And yes, there are a couple of downward moves. Certainly after the internet bubble of 2000, we had a couple of years where rates came down, and they are there. But in the scheme of things, the market goes up. The Dow, of course, on the other hand, has had significant ups and downs. Unfortunately, you can't even see this little blip in 1987. If you can look at the dates along the bottom, there's a little jump down in 1987. At the time was a gigantic loss. But in the scheme of things, the market's been so much more volatile with such big swings that it looks like nothing. So I guess in another 20, 30 years, the swings that we see now will look small. Okay, and here's a picture of VIX. So you can see that it makes these very fast moves up, and then a lot of little moves down with little spikes. Those little spikes will give us an opportunity to sell. Okay, the first strategy. The first strategy I call short cycle. It's based on a system developed by a fellow named George W. Taylor. I think it's W. George Taylor in the 1950s. What it is, it says that if the S&P goes down 3 days in a row, at least the original strategy, the S&P goes down 3 days in a row, given certain conditions, we want to be a buyer because it doesn't often go down more than 3 days in a row. And we want to hold that trade for no more than 3 days. Now, while we're doing that, we're going to have a profit target so that the market moves in our favor. We're going to get out even the next day, which happens pretty often. And we're going to be able to trade on the close, because if the market has gone down 2 days in a row, then you can know easily that if it closes lower tomorrow, I want to be in on that close. So you can either place that order in advance, or you can watch the market 5 minutes before the close and do it yourself. And if it doesn't hit your profit target, you're out in 3 days. Pretty simple. The interesting part is, of course, the volatility. The profit targets are based on volatility, and so having a good profit target increases the percentage of good trades from 55 to 75 or 80%. Very, very appealing way to trade. Now here are the rules, which I've more or less just told you, that we'll be buying on the third day of a lower close and exiting on the third day, 2 full trading days, if the profit hasn't been hit. Now notice on the short side, we will sell short on the 4th day, which really shows you that there's a bias. We want to be a bit more careful because the index markets tend to be up more than down. So we'll give it an extra day to go short. And we'll also create a profit target based on volatility and exit on the second day instead of the third day. So we'll only be in the shorts for one day instead of 2 full days. And as I said, that conforms to the concept of the fact that there's a clear upwards bias in the stock market. And there is a little trend filter put in this so that we're not fighting the market and we're not buying when the market is collapsing. But I won't quite tell you what those filters are because I don't want you running out and developing this yourself. So this is what it looks like. You see the frequency of trading. It buys a lot. And then the PT on the chart says we took profits, and there are quite a lot of profit taking there. And of course, if you're familiar with the expert commentary, you can position your pointer on various signals, and it will tell you what was there, profit taking, what we did, when we entered, when we exited. And then there's this description of the system on the left. In case you forget what we're doing, I've written a little explanation of why this system works and what we're doing. Okay, let's go to the mean reversion system. This is the one that I said was a little geeky. And it turns out that there are different ways to calculate a trend. You know, moving averages, there are breakouts, regression, exponential smoothing, and others. It turns out that the way you calculate has a different lag. So if I do a trend, a 10-day trend, and I do a 10-day linear regression, the way they identify the trend will not be exactly the same. The moving average might be a day ahead of the linear regression sometimes. Linear regression may be a day ahead of the moving average sometime. It turns out that that lag, when you use the same number of days to calculate these two different approaches, there's a lag. This lag will cause one of these trends to go short or long before the other. And we will do the opposite. So when we get, let's say we're doing a moving average and a regression, and the regression goes short and the moving average is still long, we will buy based on essentially the regression crossing the moving average going down. So we're going to treat it as mean reversion. And mean reversion, as I said, or maybe I didn't say, but trends don't really work well in the short term. These moving averages are meant to work with macro trends. They try to duplicate the policy of the Federal Reserve. So the moving average can come very close to tracking interest rates and staying long when the Fed is lowering rates. Well, I'm thinking of the futures markets, and short when they're raising rates. In the short term, I'm not convinced that there are trends. There are bursts of market movement because of news articles. There's a little supply-demand imbalance that causes markets to move. But the moves in these shorter term time periods are very erratic. And therefore, they don't make money for a trend follower. Based on that, and this interesting lag between these two trend approaches, when the trend turns down, you can do the opposite and feel very comfortable that you're going to come out ahead because you know that the trend is not going to work. These markets will not sustain that direction. And by picking markets that have a lot of noise, you exaggerate that tendency for the market to change direction quickly. So this turns out to be very reliable. It's also the most robust of the systems in that you can trade many more markets with this. because many more markets don't trend when you look at them up close. So I think I've just explained in my own words what I've just said on this. It does also set profit targets based on volatility, and it likes noise. All short-term systems like noise. And this is what it looks like. It goes in, it holds the trade a little longer, you'll see, and it does quite well. And again, there's an expert commentary. It will tell you when to buy and sell, and when to take profits and when to get out. Now, VIX. VIX is really interesting, I mentioned, because it's extreme seeking, and it has a very different profile. In the late 1990s, there was a system called high momentum, or there was a technique called high momentum trading, and it was used by the professionals. If you're familiar with indicators like the RSI or stochastics, they usually show overbought and oversold levels. So when the RSI gets over 70 or under 30, it's overbought and oversold, and you expect it to change direction. Or when the stochastic gets over 80, under 20, you expect the same thing. Most people use these indicators for timing and for deciding that, well, my trend is long, I'll wait till the stochastic falls under 20 and I'll buy at a better price. Well, we don't do that with the VIX. When the VIX gets overbought, it continues to move strongly upward for a few days. When it gets oversold, it continues to go down for a few days. So we're going to track that. We're going to go with that movement, but only stay with it for a few days. So when we get a movement down in the VIX, we're going to sell. Again, we're going to have profit targets, and we're going to get out pretty quickly. And so the rules here say, after 2 days of a lower close, we're going to sell the next day's open, or we're going to sell the next day's close if it's lower. So we're looking for a confirmation that the market is going to continue lower after the 2 days. All right, it's almost the opposite of the short cycle. And again, we're going to have an asymmetric rule. After 3 days of higher closes, we're going to buy the next day on the open, not on the close. So we're looking to get in as quickly as possible when the market is moving higher. Although we need this extra day to confirm that it is moving higher. We will have profit targets based on volatility, and they can be hit anytime. And by the way, I place these profit targets overnight in those markets that trade 24 hours, because I'm going to take them one way or the other. And if they get hit overnight, fine and dandy, a profit is a profit. And if we don't get out on profit taking, we get out after 2 days on the close. So these are all pretty short term. And here's a picture of the VIX trades, and you'll see that there are a lot more shorts and a few longs. So it does go long and short. It's hard to see the profit taking on this, but there is profit taking, and it's a very reliable system. And just so you know, in general, these 3 systems are not optimized. This is the way they were. You can see these patterns in the 3 systems are very similar. The concepts have been around a long time, and mostly I have made them skewed to long and short, and I've improved on the profit taking, and I've just verified that the number of days you want to hold the trade is longer or shorter based on the current kind of markets that we see. So there we have the 3 systems. Now, here's a list of those markets that they trade. In the short cycle, you can trade almost any index ETF or index futures market. As I say here, the more noise, the better, and long positions do best. In the mean reversion, the ones that I found most appealing were S&P and NASDAQ futures, but also you'll see these index ETFs, the S&P, NASDAQ, the small caps IWM, the double leveraged S&P bonds, and also UVXY, which is the VIX ETF. And there's a generic strategy in this add-in that you can try with any market. So you can fool with it yourself. I would not recommend using this for single stocks. Single stocks don't have the noise. And remember, we're looking for noise. You get the noise by putting together a lot of different markets doing different things. So that's why the index works much better. And I would really avoid applying it to a stock, even if you test it and it looks good. On the high momentum, all ETFs having to do with VIX are fine. You've got the long or the short, SVXY, and the VIX futures. And there are a number of other VIX ETFs put out by other companies that you could look at. It's your choice. Again, on the VIX, shorts do best. And on the bottom, a reminder that any noisy market is going to be good for any one of these three systems. And just to keep you honest, my own advice, be sure you start small and monitor your returns. This trading, even when it does well, trading has risk. And you're going to make a lot of profitable trades, but you might get a few single larger losses. You need to learn what the profile is. You can probably see it from the historic performance, but there's nothing like trading yourself to get the feel of a system. And again, you will have periods of losses. They're really not many, but it's trading. And if you've had practice, you get immune to losses. You take them as a natural course of things. I've been doing this for a long time. I used to get very nervous anytime I took a loss. Now it has to be a much bigger loss before I get nervous, but I still get nervous. Now, you also need to understand risk. Personally, I always put equal risk on every trade. And I do that in futures by volatility adjusting every position size. And you may know how to do that. You take some investment size in futures and you divide by the dollar value of the, say, 20-day average true range. In stocks, the easiest thing to do is just take a fixed amount like $10,000 and divide by the price. It's not great, but it's much better than saying, okay, I'm going to make more money on this trade than another one, and you put a large amount on a particular trade and it doesn't do well. You really can't do that. None of us really know that a particular trade is going to be good or better than another trade at any one time. So I think that's really important to manage this risk and to try to make every trade of equal risk, which maximizes your diversification. And these three systems are very different. You could trade all three at the same time and they won't collide with one another. You won't be doubling up on the same position. So I think that's it. I think you'll enjoy trading these. They're a lot of fun. I enjoy short-term trading, even though the bulk of my portfolio is in trend following. It's just fun to trade in and out of something and to put the money in your pocket. And that's it. I assume if you have questions, I'm happy to answer them. I'm here. Jeff, you want to take over?
my microphone is. Oh, there it is. Oh, Perry. Okay. All right. Hey, Perry, how are you?
I'm fine, thanks. How are you? Where have you been?
Well, I was trying to figure out where my mute button was. I've been here the whole time. We do have some questions that are coming in. AB
Sure.
Webb says, Perry, can you show the equity curves? I'll show that actually for the sample
Yeah,
trades we showed on the charts for this webinar. This gives us a feeling for the probability of these three systems. So I'm going to cover that. I
but
think
I,
what. Go
yeah,
ahead.
I would suggest that each person look. I mean, you can look at the equity curve on Metastock with no trouble. Before you trade any one of these systems with any one of these markets, you should look at the equity curve to see what the risk is.
I wanted to have a
It's right.
little.
It's
Yeah.
right there.
Yeah, absolutely. I mean, this is a fully integrated version of Metastock. I want to talk to you a little bit about kind of some of the things that I think are quite unique about this add-on that I like a lot. Typically, and it might be polarizing. Some people really may not like the fact that this is designed to hold for 2 or 4 days, right? And I'm going to let you kind of chime in on this. One of the first things that I learned from actually it's Price Headley, but he likes to talk about the concept of efficiency, right? So, like for example, today I'm going to get done with the webinar, and I'm going to be gone home probably around 5 o'clock, right? And I'm going to probably take around an hour to get home. It's going to take me from 5 p.m. to 6 p.m. if I'm lucky to get home. Whereas usually on a day where we're not doing a webinar, what I will do is I'll just basically, it takes about 30 minutes. So I'm going to take double the amount of time. And so it's not as efficient for me to drive home after a webinar, right? The concept's the same in the market. Would you rather make, let's say, hypothetically, and I'm not certainly not saying this is even a realistic number, but would you rather make 30% in a few days or over the course of a year? Right? But it's even more important because, like, if we're in short-term trades where we're in the market for 2 to 4 days, that opens up our capital to be available for other trades, right? Or if we don't want to take other trades, we at a bare minimum, our money or our equity, our account isn't at risk. So I actually really like the fact that it's ultra short-term. I think it's also one of the shortest term add-ons that we actually have in the library. So that's a kind of a general thought. Go ahead, Perry.
Jeff, can I interrupt?
Of course, you're the expert.
Oh, good. You just mentioned something. You mentioned something very important that I forgot all about. These short-term systems are not in the market all the time. Now, it's not a matter of whether you use the money for something else. It's a matter of the fact that by not being in the market, you're not going to be exposed to a price shock all the time. That, the market will jump around and do things. And if you're a trend follower, you're going to be hit with a price shock every time because you're always in the market. If you're trading short term and you're out of the market 50% of the time or 30% of the time, that's 30% less chance you have of having a price shock. And price shocks traditionally go against you. So it really reduces your risk. Okay, that's what I had to say.
Oh, yeah, that's great. AB Webb does really want to kind of, so let me kind of talk a little bit about, I'm going to go ahead and, I think we can kind of jump into Metastock. So I'm going to turn myself into the presenter right now. And so everybody should be able to see my screen. And since AB is asking for it, I'm just going to show quickly kind of like what the equity curve looks like. This was a friend of mine, actually also, we have a lot of Canadians here too, by the way, Perry, but a friend of mine actually said, well, how does this perform on, he wanted to know the DIA, and so I just ran a quick system test for him yesterday, went back about a year in history, and I just throw in quite a few symbols for that. And instead of actually just showing kind of like a test, which we could do, I'll show the test that we ran there yesterday. Give me 1 second.
You're showing your browser on GoTo.
Oh, okay. I'm being told that you guys can see my browser screen. So let's go ahead and change that over. And You should be able to see my meta stock
That
program
was
now.
just in GoToWebinar.
Okay.
YouTube was
Okay.
All right. So now everybody that's watching the screen can see the proper screen. But let's go ahead and kind of take a look. So did about a year of history. It was my wife's birthday on Monday. I was trying to get like something for him to look at real quick. And so what I had done is I tested quite a few of the ETFs. And right here, if you kind of take a look at how I tested like SPY against SPY and DIA and stuff like that. But on an average equity curve, it actually looks really, really good. If I go into it a little bit further, we can kind of see that we just tested the DIA and the SPY. So on average, looking at kind of the way that this tested out, it's giving us a positive equity curve. We can actually go in a little bit further. I don't remember the options that were in here, but we can go in a little bit further and see how the performance looks, how many trades we would have made, how many would have been profitable, how many would have not been profitable. All that stuff is broken down in the add-on, how it compared versus the buy and the hold, what our profit versus our losses look like. So it does have that entire system test capability for you, AB. And thanks for the question. Let's see if we have another one. And there's a few other things that I want to show you now that I'm sharing the proper screen. But AB has another question for you, Perry. Would you say
Sure.
that there's a 0% of optimization and 0% curve fitting to the three systems the way you've traded them?
0%. Well, it depends whether you think of optimization as something you locate on the computer or you can do in your brain. I intrinsically know that I want to be long more days than I'm short. And I don't need to optimize that to know that I'll hold a long position one day longer and a short position one day shorter. So if you consider that optimization, there you are. But other than that, no, there was no mass testing on any of these systems.
And this actually goes straight to a question Sam is asking out of the chat. In general, is there a long bias? And I know the answer, but I'm going to let you answer it.
I'm sorry, in general, is there a lot of what?
Is there a long or a bullish bias in these systems?
Yes.
Yeah.
Yes, there is a trend of a sort in almost all of them. I mentioned it quickly so that we avoid being long and a serious move down. Otherwise, if we're buying on the third day down and we're in a serious free fall, you don't want to be buying. And so you do need a trend indicator in these things to avoid these serious losses.
Perfect. So, and particularly like the short cycle and the high momentum, and you please correct me if I'm wrong, but those were specifically built around the bias that you see towards the long side. Let's call it the bullish bias. The bullish
Yes,
bias you see in the
absolutely.
stock market, and we
Right.
are only recommending. That's another thing that I love about this. Would recommend you trade it with like index ETFs, like the Spider, the Dow Industrial Average. Futures would work as well. So if you wanted to do like the E-minis, you could. But we're really recommended particularly for the short cycle and the mean reversion. Those are applied towards either futures or ETFs that apply directly to an index. So,
Yeah, let me just remind people that if you're going to take a short side, that futures are better when you're shorting because of the leverage. You don't need as big a move in order to make money. And that's quite important. So if you're trading ETFs, you're going to want to stick to the long side of most everything, except of course the VIX.
Now the difference is going to be that high momentum system, and that one's developed around the VIX. The idea being the VIX spikes out of control crazy as fear comes into the market, and it takes a while to settle down. So it's more likely to go short and take longer positions in short than it is to go long, and it'll take shorter positions long when it does, right?
I don't know. These long and short terms are getting me confused.
Let's just say bullish and bearish.
Let's say that VIX spends more time going down than it does going up. It goes up fast, it goes down slowly.
Right.
So we're going to have a lot more short sales and a few buys, and we're going to hold the buys much shorter, and we're going to hold the short sales for an extra day or so.
Cool. Awesome. I do want to show off a few things. I'm just kind of clicking back into the YouTube browser to see if we have questions coming through. And I don't see any. So if you have a question on YouTube and I missed it, retype it for me. I didn't miss it on purpose. But in any case, there's a few things that I kind of want to show. Like I did say before, it is a bit of a full integration in Metastock. So right now we're looking at the mean reversion SPY system, but I have it on the Dow Industrial Average. As you guys know, I like to look at the Dow Industrial Average. The Expert Advisor, just to kind of show you a little bit about how that works. Yesterday we did get filled on a buy. Right here we got filled on a buy. We went short right here. We went short also right here. So you can kind of see that it is important to be kind of using this with stops and that kind of stuff. But you can also see that it takes some really good shorter term trades. Because we integrated the commentary that's in here, I'm going to go ahead and just show you kind of what it says on this day where you get a short signal. So it's going to tell you that you have a new entry signal. The conditions are favorable for a new short position. This system particularly does not use any stops, but you're free to set any stops you wish to protect your investments. And then when we get a condition to go long, it'll appear on the chart as well. You're also going to have a bullish and a bearish bias as a trend ribbon. Now, since this isn't actually recommending stops for this mean reversion system, Perry, do you have any advice on how you would set stops?
How I would set stops on this?
Yeah.
Good question, because if you bought towards the bottom here and you had a stop, it looks like you'd get stopped out before it had a chance to run up in the center.
Mm-hmm. Yeah. It's always an interesting question, right? Like, are you going to give yourself enough room to fish? Are you going to cut it out early? But I'm going to let you finish talking.
Well, personally, I don't like stops. There are only a few systems I will use stops, and most of them are arbitrage. I look at the risk of the system. If you go over the equity curve and you look at how much risk you can expect, and you make sure that you capitalize your account to absorb that type of risk. And chances are you won't see that extreme risk very often. And sometimes you won't see it at all unless we have another 2008. But you need to, I think, just capitalize correctly and go with the system. One of the problems with putting a stop is that you will get, in a case like buying at the bottom of this chart, you might get stopped out and the system will turn around and have a very nice trade. I don't want that. I look at the percentages. The system makes, 60 or 65% good trades. It makes money over time with reasonably modest drawdowns. I'm just going to go with that. But I'm going to diversify by doing other things at the same time.
I'm going to switch charts just because it's requested from Sam Laurie. So he wants to look at the E-mini or cotton. So we will look at the E-mini. We wouldn't recommend this for cotton, right?
I'm sorry, we wouldn't recommend this for what?
For trading cotton. We really are kind of recommending that people use this to trade index ETFs, not cotton futures.
Oh, cotton.
Yeah.
Oh, I'm sorry.
No problem.
It wasn't your pronunciation, I guess. I just wasn't expecting to hear that.
Yeah. No. Okay. So, okay. No problem at all. Yeah. So.
No, it needs noisy markets, and I showed that chart of ranking of noise with the interest rates on one end and the index markets on the other. We're looking for markets with noise.
And here is a full screen view, Sam, for you of the ESC1. So just a continuous of the S&P Mini. And you'll notice there's actually a lot of good trades that come up. So there you go. There's a full screen view of it. Okay. All right. Looks like we're running out of questions. So I did show system testing. I showed kind of the expert advisor, how that works. We also do have scanning. So with scanning, I'm not sure it's as important with this one because generally you're going to be following it with S&P indexes and ETFs and the VIX. And so you just open up the chart. But if you do want to kind of run a scan against maybe the more common ETFs for it, we do have the scans that are built in for you. So, and you'll notice there's different versions of them. You've got the high momentum pending. This just tells you that it could generate a signal. It doesn't necessarily mean a signal has been generated. And then you've got the ones that are actually have generated a signal. You've got high momentum, and then you've got short cycle for ETFs, pending and signal, as well as for futures. So there are scans that are put together that you can run. But again, this is a bit of I'm going to call it a focus product. So it's really been kind of catered towards how the instruments like the VIX or the index ETFs actually work. And as a result, it's not going. I don't think scanning is going to be that important for most people. Like you're just going to open up ESC1 and take a look to see if there's signals and that kind of stuff on a day-by-day basis. But it's there for you if you want to use it. You're going to run the test to see how well it works and what your drawdowns look like. But scanning is there. It's an important feature. This product is just focused so much. I just don't think it'll be as important with this particular one. So let's go ahead and let me go back into the PowerPoint. I see the questions kind of coming down a little bit. So let's just hack a little. So those are the three strategies that are included. You've got the explorations, the expert advisors, the system tests. It is a full-blown add-on to Metastock. The other thing that I like is you do have the explorations, and you've got the sell signals. And so for this one, somebody guessed it already in the chat. It's a one-time cost of $499. Here at the webinar today, it's a one-time cost of $399. We do back it with our 30-day money-back guarantee. We want it to work for you. Our argument is if it at $400, it's worth it. It's actually, if it helps you make better trades, it's probably worth far more than that. But we will back it with our money-back guarantee, so your risk is really nothing. If you'd like to order it, go to metastock.com/Kaufman, or you can give us a call at 800-882-3040, or you can chat online with us at metastock.com/saleschat if you have other questions. They'll be happy to send you charts or anything that you want to see. And I think that's what I've got. There is a little bit of a typo I just noticed in my PowerPoint. It should say sales chat and not sales chat. So anyway, Perry, do you have any final thoughts?
Is that me you're talking to?
I said it, yeah. Do you have any final thoughts?
Final thoughts? I never have any final thoughts. No, I think I've said everything. I think the examples in the short cycle and the VIX would have been more interesting than the mean reversion.
You want to look at those?
No, I think that the people that are interested in the system should
give us a call.
Really look at them.
Yeah,
they really need to look at them. It's the due diligence. I think you'll find that the performance is quite good, but it's very realistic. There are a few drawdowns here and there, and you have to be prepared. You at least have to know that it happens. So I think it's worth doing your homework. When you get the add-on, you should go through each system and look at the different markets, and then try some markets that you think might be good yourself, and look at the equity curve. I think you'll be quite pleased, but you have to be realistic.
And I always recommend when you're adding something to your routine, paper trade it. Take really small positions as you kind of get to know it and kind of build confidence. Because it's all really about discipline when it comes down to it, right?
Yep. No, I agree absolutely. Always start small, and and it does give you confidence and familiarity with the system.
Yeah. Well, I want to say thank you, Perry, for the time. This is such an interesting concept. I love it. Thank you for all the work you put in with William to kind of create this and put it together.
My pleasure.
And for everybody that came, thanks for coming today. I hope you enjoyed it. I hope you learned something. And well, we'll see you at the next one.
Okay.